Welcome to the deep dive. Today, we're digging into a really fascinating recent investment decision.
Yeah, it's caught a lot of attention.
We've got sources detailing why the well-known investor Josh Brown decided to sell his long-held stake in Alphabet, that's Google's parent company, and pivot into Netflix.
Exactly. So our mission today is pretty clear. Unpack the why behind this move.
And figure out what it might signal for navigating, the market right now.
Absolutely. Our analysis is based on market discussions where Brown himself laid out his rationale. Selling Alphabet, buying Netflix.
And for you, our listeners, this deep dive should offer some real insights into how experienced investors are thinking about market uncertainty, the long game for big tech.
We'll break down the main arguments, the potential implications, all without getting bogged down in jargon.
Okay, so let's jump right into the Alphabet exit. Why sell now?
Well, according to Brown, the core reason seems to be rising competition, specifically in AI.
Right, and also a shift he sees in how younger generations get information.
Precisely. They might be bypassing traditional search engines more often.
So what specific worries were mentioned?
A few key things. One is the potential for specialized AI agents to kind of take over specific information tasks.
Meaning you wouldn't always need a general search engine like Google for everything.
Exactly. It's a sort of disintermediation risk for Google's core search function. That's a major concern.
Okay, what else?
There's also Alphabet's heavy reliance on ad revenue, how much it can swing up and down.
Compared to, say, Meta.
Well, yes, though Meta is also heavily ad-dependent. But the specific concern for Alphabet is the potential disruption to its search-based ad model from AI chatbots like ChatGPT.
And the market is starting to notice these risks.
That seems to be the view, leading to potentially lower valuation multiples for Alphabet.
Valuation multiples, just quickly, what does that mean for listeners maybe not familiar?
Sure. It's basically what investors are willing to pay for each dollar of a company's earnings. If the multiple gets compressed, it means investors are less optimistic about future growth compared to current earnings.
So they pay less for those earnings. Got it.
Yeah.
But interestingly, even after selling, Brown apparently still sees Alphabet as, well, potentially a buy at current levels.
That's right. He does acknowledge its diversified businesses. You've got YouTube, Google Cloud, Android, Waymo. It's not a single-trip Tony.
But he prefers Meta. Why is that?
Yeah, his preference leans towards Meta. The analysis suggests Instagram's visual-based advertising might be more resilient to some of those privacy policy changes affecting digital ads, compared to search ads anyway.
Okay, so more resilient ads.
And he perceives stronger potential for earnings growth at Meta.
Anything else driving that Meta preference?
Our sources also point to his view on Meta's metaverse focus. It's early days, obviously, but he sees it as a longer-term growth prospect on top of Instagram's continued strength.
So kind of a combination of current strength and a potential future growth engine.
Right. He thinks that combo might offer a higher growth ceiling than Alphabet's core businesses in the current climate.
So just to be clear, the worry isn't that Alphabet is about to collapse or anything?
No, not at all. It's more about potentially slower growth ahead and maybe a less attractive stock valuation compared to other options, like Meta in his view.
Okay, that makes sense. Let's pivot then to the other side of this. The investment in Netflix. Why Netflix? What does that tell us?
This is framed more as a defensive move, actually, in an uncertain market.
Defensive? How so?
Well, first, look at the stock's performance since the market peak back in February. Netflix was down only about 6%.
Part two.
Compared to the S&P 500 being down 12% and the NASDAQ down 15%. So relative strength there.
For listeners, the S&P 500 and NASDAQ are just major indexes tracking big groups of U.S. stocks, right?
Exactly. Key benchmarks.
Okay, so relative strength is one factor. What else?
The strength of the business model itself. You've got recurring revenue from subscriptions, which investors love.
Predictable income.
Right. Plus, pricing power. They've shown they can raise prices. And then there's the ad-supported tier.
Ah, yes, the cheaper plan with ads. How's that doing?
It's growing, and interestingly, it's reportedly more profitable per user than the premium tiers.
Really? That's fascinating. So even if people trade down to save money, Netflix potentially makes more.
That seems to be the dynamic. It's definitely something for listeners to consider when evaluating their potential.
And then there are the long-term ambitions the Netflix execs keep talking about.
Absolutely. They're aiming to basically double revenue by 2030.
Wow.
And potentially hit a $1 trillion market cap. They're around, what, $400 billion now? So that's a huge growth target.
That is ambitious. Do the sources mention any potential roadblocks, like increased competition from other streamers or changing viewing habits?
Those risks are always there, definitely. But the core argument Brown seems to be making revolves around resilience.
Which brings us to this idea of Netflix as a consumer defensive stock. What does that mean in practice?
It's a key part of the thesis. The idea is, even if the economy slows down, people are less likely to cancel their Netflix subscription.
Especially with that cheaper ad-supported option available now.
Exactly. Think of consumer defensive, like companies selling things people keep buying, even in tough times: food, utilities, and arguably basic entertainment like Netflix.
So it's seen as less of a discretionary spend, less easy to cut than maybe, say, going out to the movies often.
That's the argument. It positions Netflix differently.
Let's talk valuation, though, because there's a pretty stark difference there.
Oh, absolutely. Looking at forward price-to-earnings ratios, Netflix is trading around 40.
40 times expected earnings. And Alphabet.
Alphabet's around 18, Meta's around 20.
So Netflix is significantly more expensive based on that metric. How does Brown justify paying that premium?
It comes down to belief in that strong future growth trajectory we talked about. He's betting on that continued expansion.
It's a real contrast, isn't it? Paying up for Netflix's potential versus the more established earnings of Alphabet and Meta.
It really highlights the different bets being made here. Growth versus perhaps perceived value or stability.
But he doesn't see Netflix as risk-free, does he? He mentioned potential buying opportunities later.
No, definitely not risk-free. He acknowledges the history here.
Yeah.
Netflix stock can be volatile.
Right.
We've seen big pullbacks before, like 30%, even 50%, sometimes triggered by slowing subscriber growth.
Or worries about how much they're spending on making new shows and movies.
Exactly. Concerns about rising content spend. So he anticipates that these kinds of concerns could pop up again.
And that could create a better entry point.
That's what he seemed to be suggesting. Maybe sometime in the next 6 to 12 months, if those risks cause the stock to dip.
But isn't there a risk of, like, streaming saturation? So many services out there now. Can subscriber growth really continue indefinitely?
That's a valid question, especially if content quality dips or prices keep rising. That's certainly a long-term risk factor for the entire industry, not just Netflix.
Okay, so pulling it all together, what are the key takeaways for investors from this analysis, according to the source material? For listeners, what can we learn about thinking through risk and reward in tech right now?
Well, the main emphasis seems to be on focusing on resilient business models, especially when the market feels uncertain.
And Netflix, with its subscriptions and ad tier, fits that profile in his view.
Correct. For Alphabet, the takeaway is that its future really hinges on navigating this whole AI evolution successfully.
And adapting its core business.
Yes. And more broadly, it highlights the importance of balancing, growth potential with defensive qualities in your investment portfolio.
So to wrap up, we've seen how one experienced investor is reassessing major tech players. He's prioritizing resilience and perceived long-term growth in streaming.
Over potential headwinds facing the traditional search and advertising models, particularly with the rise of AI.
Right. This deep dive into Josh Brown's portfolio shift really gives a snapshot of current market thinking, or at least one influential perspective.
And it leaves us with a final thought, maybe something for you, the listener, to consider. With AI advancing so rapidly and the entertainment landscape always shifting, what other companies that seem dominant today, might face similar kinds of structural shifts or challenges in the coming years? What would you look for to spot those vulnerabilities or maybe spot the next big emerging opportunity?